I don't advertise it that much because most of the time, because of tax season and because I have other businesses, I pretty much just do referrals. For most of the time, I don't really advertise that I am a real estate agent. So I know the information on both angles, but we're going to talk about when it comes to your taxes. So, first of all, when you're purchasing a home, the write-offs that you usually have for purchasing a home is your mortgage interest and your property tax. For some reason, people think that all the stuff that's on their closing documents that they can write off on their taxes, and that's not necessarily so. So usually it's your mortgage interest, it's your property tax, it's your points that you might have, discount points that you might have paid, so that you can get a lower interest rate. So it's those particular things that you are utilizing when you purchase a home. Now, what you need to know is that you don't automatically, or you're not able to just write that off. So that doesn't mean that when you take your mortgage statement into a tax company that you're just going to automatically get some money for paying something on your home. That's not how it works. So if you own a home, what that does, and let's clarify something too. Because some people own a home and they don't have a mortgage. So if you don't have a mortgage on your home and you don't have like other expenses that I'm getting ready to talk about, then you can't necessarily utilize your home to write it off when it comes to owning a home. You have to, most of the time, be paying a mortgage interest, a mortgage. And the reason why that matters is because you're able to write off your mortgage interest. So for people who own a home, you have to qualify to be able to write that information about your home off. And you usually do that on a form Schedule A. And it's called the itemized form. The slang term for it, and I don't hear that many people saying it anymore, but I know back in the days you used to say it all the time. It's the long form. Do you know how to do the long form? And that's a Schedule A itemized deduction. So in order for you to write your home off, you have to qualify to be able to itemize. Now, there's two different types of deductions. It's a standard deduction and the itemized deduction. The standard deduction is a government give me, okay? That means you automatically get that deduction based off your filing status. That's a dollar amount that the IRS give you for you to be able to deduct automatically from your income that you're not taxed on, okay? Now, if you own a home, you have an option now that instead of using the standard deduction, if your personal expenses are more than the standard deduction, then you're able to use the itemized deduction, and then that's more money that you helped yourself from being taxed on. That's how it works. It doesn't work where you just have mortgage interest, property taxes, and you get to write that off. You have to qualify for that with other personal expenses. So let's talk about that, right? So in the last couple of years, it's been harder for homeowners to be able to itemize because I'm thinking about 3-4 years ago, I don't know the exact time frame, the government, Congress, whoever made the laws when it comes to taxes, they changed the standard deduction amount and they made it higher. It was supposed to be beneficial to y'all, but it really wasn't beneficial to y'all, but I'm not going to go into all of that, right? So they made it higher. And because they made it higher, a lot of people do not have enough personal expenses to write off to exceed their standard deduction, so they automatically have to use the standard deduction instead of the itemized deduction. So with the itemized deduction, usually people who are using that's a homeowner, is people who have, say, higher mortgage interest. That would be for people who have, say, homes that are 2 250K and more. Usually if your home is 250K or more, then your mortgage interest is going to be high for the year. Now, people who homes are under 250K, your mortgage interest might not be as high, but that doesn't mean necessarily that you can't use that as a write-off. But I just want to say, like, most people who have high mortgage interest are people who have homes that are 250 and more. Their mortgage interest will be real high. All right. Now, because you have people who've been paying on their home for a long time. Like, I got a home. I think I own a home for like 21 years or something like that. Let me see how long I own my home. Oh, no, not 21. Oh, no. Girl, you own that house for 23. So I'm almost through paying for it. So I'm on a home for 23 years. And I think my mortgage interest now is like maybe $1,000 and something a year or $1,500 a year. I can't do that with it. Now I got another house too, so I can add both of them if I'm not using that one as a rental property. But I can't really do nothing with that unless I have a whole lot of other things to write off. So to me, I say it starts with your mortgage interest. It don't necessarily have to, but that's one of the higher dollar amounts that you can start utilizing to see if you can exceed the standard deduction. Then you have real estate taxes. Real estate taxes are just high. You can own a property that's under 250K and still have high property tax. I think I owe like something like $100,000 on my main home, and my property tax was $5,000. So it's crazy, but you know the home values are up. So when they're up, your property tax is up. So you're able to write off your property tax. Now, for those who don't know, property tax is an interchangeable word for your real estate tax. So it's your real estate tax that you pay, that they take out your mortgage every month, right? Those are the two things that I say you kind of get started to figure out if you can itemize. There's other things too, but those are the two main things when you're a homeowner. And then if you're able to write off those two things, then you start to think what else is on the itemized deduction form that you might have. So one is medical bills. Medical bills, people need to know this too, that when medical bills, you can't just automatically write off medical bills either. Your medical bills have to be 7.5% of your AGI. I'm not going to go into all that unless you know what those two terminologies are. Then it is what it is, but your medical bills that you pay has to be 7.5% of your AGI in order for it to calculate on that particular form. Now, if it is, then that helps you when it comes to having a higher dollar amount to try to help you exceed your standard deduction so that you can write off and utilize you being a homeowner. Now, the other thing that a lot of people don't talk about is you get to write off the state taxes that you paid. Okay, so if you had a job, so if you had a job and they withheld state taxes from your W-2, then whatever that dollar amount is, it can go on a Schedule A. Now, for people who might be self-employed and you might not have paid no state taxes, or you live in a state that does not, you don't have to pay state taxes, then you have the options to use general sales tax instead of state tax. But note this, no, it's not. Yeah, you're able to use the general sales tax, but it is. But I'm gonna talk about the other part of that later. Then you have, like we said before, your real estate and your property tax. Now, they have a limit on that. You can't, between the state tax and the real estate tax, Avalon tax, all the different taxes on the Schedule A, they're not going to allow you to write more than $10,000 off on that particular form. So you have really, really high real estate taxes and you pay a lot of state taxes. Then if it exceeds $10,000, they're going to cap you at $10,000. So you can only write $10,000 of that off. Then you have where we talk about your different types of interest. So it's the interest that you pay on your home. If you refinanced your home and did an equity loan, you can write off the interest on that. You can write off the points. Like if you did a refi or you purchased your home and you pay discount points, then you can write that off. Now, what they used to have on there that they took away for this year from homeowners, which I'm so mad about, it's the mortgage insurance premium, because a lot of homeowners pay mortgage insurance premium. I had two people, I think yesterday, that they mortgage insurance premium was really, really high. One of them was like $7,500. One person had paid $9,900 in mortgage insurance premium, and they could not write it off. That was a large number because their interest was actually lower than a mortgage insurance premium because they had just purchased their homes, and that would have elevated them to possibly be able to itemize, especially because both of them were single. And if your mortgage insurance premium was $9,900, you're almost there to exceed your standard deduction. So that's kind of how it works. And then you have like other miscellaneous things that you can write. Oh, charitable donations. So of course you can write off charitable donations if you pay church tithes, if you make monetary donations to any approved 501c3 nonprofit organization, and anything